Hi there, my name is Showit and this is Finance Central. Today I talk about bonds, which is a contrast to the last video I made about stocks. I will attempt to explain the mechanics of a bond and what you can expect from investing in the bond market. Another quick reminder to like this video and subscribe to my channel to help out with serving my videos to a new audience. Also, please leave a comment below to suggest any topics you would like me to make videos on. Again, I will start with the definition given by Investopedia. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically a corporate or governmental bond. Let us first understand fixed income. At the time of procuring a bond, you are aware of all the returns you will get throughout the life of this financial instrument. A bond typically consists of three components: the bond price, the term, and the coupon rate. When a bond is issued by the government or a corporation, these components are known, and whoever is in the market to purchase the bond will assess if they are fair given the market conditions and the risk of the underlying assets. The terms on these bonds may be anywhere between 1 year or 30 years. A bond can be a zero coupon bond, which means that it does not pay the debt owner anything until the day the bond matures, or it could be a coupon bond, which in the United States generally means that it pays a certain coupon rate every 6 months, or in other words, semi-annually. For example, a 3-year bond will make 6 coupon payments. If the bond is for $1,000 face value and the coupon rate is 8%, then the semi-annual cash flow is $40. If you purchase this bond on the day of issue and hold it till maturity, you will get paid $40 6 times, and on the 6th time, you will receive the $1,000 face value additionally. During the term of this bond, depending on the market conditions and how much time is left to the maturity of this bond, the price of the bond will keep fluctuating. If you wish to get rid of the bond, you can sell it in the bond market at the prevailing price. Assuming interest rates remain constant throughout the life of the bond can trade at a premium or at a discount. To make things more relatable, let us take a look at an example in Excel. As you can see here, this is a bond valuation example. Let's say the face value of this bond is $1,000. The annual coupon rate is 8%. Now the annual required return can be lower or higher than 8%. If it is higher, then the bond will trade at a discount. The years to maturity can be 3, and the payment frequency, as we said, is semi-annual, so it's twice a year. As you guessed, the price of the bond is less than $1,000, which is why it is selling at a discount. If we were to change this annual required return to less than 8%, say at 7, then this bond would trade at a premium. Let's use the same parameters to calculate the price of the bond at any given time, not just at issue. So the face value again is $1,000, coupon rate at 8%, annual required return at 9.5%, payment frequency is 2, settlement date and maturity date are required for the formula that goes into the price of the bond. So settlement date can be, say, 12, 15, 20, 20, and maturity date can be 9, 15, 2023. Without getting too much into the details of this formula, let's say the day count basis is 0 and the redemption par value as a percent of par is 100. Again, the price of the bond was calculated to be 964, which is slightly higher than the price of the bond at issue. I'll share this file at the link in the description below. Now that you understand the basics of a bond, we can look at ways to participate in the bond market. The bond market is extremely huge in terms of size compared to the stock market. For example, in 2019 alone, the global equity issuance was $540 billion, whereas the global long-term bond market issuance was $21 trillion. Bonds provide a good balance to the stock market because when bond yields are low, it means that it is cheaper to borrow money, which gets invested in the stock market as people expect stocks provide greater returns than bonds. On the other hand, if there is a stock market correction or a crash, people panic and withdraw their money from the stock market and put it in fixed income assets. Most brokerage firms will have ways to have portfolio exposure to bonds. Some bond funds even automatically reinvest the coupons into the bond. There are many different types of bonds, but here are 7 main issuer categories. Number 1 is treasury bonds, which are issued by the federal government to finance its budget deficits. Number 2 is other US government bonds. These could be bonds like Fannie Mae, Freddie Mac, Ginnie Mae, which are government agencies by themselves. Number 3 is investment-grade corporate bonds. Credit rating companies like Standard & Poor's and Moody's will provide a credit rating for corporations. Companies that carry ratings that are higher than BBB will be in this category. Number 4 is high-yield bonds. These bonds are issued by companies or financing vehicles with relatively weak balance sheets, because of which they have to provide a really high yield to make them attractive. Number 5 is foreign bonds. These are mainly used to rely on exchange rates more than interest rates. Number 6 is mortgage-backed bonds. These normally have a face value of $25,000 as compared to the smaller $1,000 or $5,000 bonds. These involve prepayment risk, as people might want to pay off their mortgages earlier. And number 7 are municipal bonds, which are often called munis in the US. Their interest is most often tax-free depending on the state. Taxable yields are generally higher than muni yields to compensate investors for the taxes. So depending on your tax bracket, you might still come out ahead with taxable bonds. I hope this has been a good quick primer for you to get your feet wet in the bond market. It is advisable for young people to have a small portion of their portfolio in bonds, but as you near your retirement and your nest egg cannot bear to have large swings with the stock market, a majority of your portfolio should be in bonds to ensure the fixed and steady income. That is all from me. I hope you will share this video with your friends and family. I shall see you in the next one. Goodbye and have a wonderful day.